Having covered my Bitcoin trading strategy in a previous video, today we look at a simple but effective gold strategy. In the Bitcoin strategy, we showed how by using the weekly and daily MACD in combination, we were able to turn a $10,000 investment into over $1 million with just 12 trades. Gold, on the other hand, is considerably less volatile than Bitcoin, and therefore our approach changes accordingly. The principle, however, remains the same. We aim to follow the trend on the way up and exit the trend on the way down, effectively providing the platform for favourable risk-reward. In the Bitcoin strategy, we used the crossing of the weekly MACD to define the trading window, and then used the daily MACD to trade within this window. In this gold trading strategy, we simply use the monthly MACD crossing and the relative strength index to initiate a trade. The strategy is arguably more of an investing approach as opposed to an active trading strategy, as it is a slow, passive method for accumulating wealth, ideally situated in a longer-term portfolio tailored to compounding returns. First, let us look at the historical performance of a buy and hold strategy for gold. We assume an initial investment of $10,000 back in January 1977. As of today, the investment would have increased to $128,000, equivalent to a compounded 1,280% return. The average annual return for the 44-year period was 7.5%. For me, however, enduring a 20-year period of declining returns, or even a sharp near 40% drop, is simply not an acceptable strategy, let alone the consequential opportunity cost. But what if I told you we could have avoided these large periods of drawdown whilst being fully invested within these green periods? The method is simple. If the monthly MACD line crosses above the signal line, whilst the relative strength index is above 50, we enter a long position. And when the monthly MACD crosses down below the signal line, we place a stop order below the closing candle. Before we present the comparative results of our strategy against a buy and hold approach, let's look at an example of the last trade taken. In March 2019, we see the monthly MACD cross and close above the signal line, and we can also see the relative strength index is at a 55, above the minimum of 50. This is a buy signal, and we take the trade. As of today, the monthly MACD has crossed and closed below the signal line, and we therefore place a stop underneath the wick of the closing candle. The relative strength index is an important addition to this longer-term strategy, and we can see here the monthly MACD crossed above the signal line. However, the relative strength index was only reading 41, below the minimum 50, and therefore it was not a qualifying position, and we stayed out of the trade. The price continued its decline the following 6 months. The relative strength indicator can be useful, and depending on the market environment, it can be used in different ways. The common belief is that if the indicator drops below 30, it's suggesting an oversold price, whereas if the indicator moves above 70, price is deemed to be overbought. If you have a strategy which is buying pullbacks in a longer-term uptrend, then buying on an oversold signal could be useful. However, if the price is in a longer-term downtrend, it is important to note that prices could remain in oversold territory for a long period of time. Therefore, in a trend-following strategy such as this, we want the relative strength index to show us strength, not weakness. We do not want to be in a trade which is being sold or even oversold. We want price to be in accumulation. In an uptrend, prices can remain in overbought territory for a long time. So how did this strategy perform over the last 44 years? If we placed each of the timeframes traded onto a continuous chart, the equity profile would look like this. The strategy would have had us invested in gold for almost 14 years, 30 years less than a buy and hold strategy, reducing opportunity cost and drawdown periods considerably. Our $10,000 investment would have turned into just over $100,000, a 1,000% return. The average annual return was 31%, and the compounded annualized return was 73%. The maximum drawdown over the 14 years of investment was 28%, again significantly less than the 63% drawdown of a buy and hold strategy. When we compare the 44-year monthly price chart of gold against our 14 years of investment, it is clear to see the advantages of using our simple MACD and relative strength rules. Perhaps for the more advanced investor willing to accept a worst-case 56% drawdown, we could use a 2-to-1 margin or trade a multiple of 2 gold ETF, in effect doubling the returns. The method proves that by buying into strength at the right time and by being patient, you can grow considerable wealth. The market in-out software I use is set to send a message to my mobile, ensuring that I never miss a signal, making this a really passive strategy. Thanks for watching. I hope you found value, and if you did, please hit the like button and consider subscribing. Bye for now.